Good day and welcome to Epack Durable Limited 3Q FY26 earnings call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Tanesha from DAM Capital Advisors Limited. Thank you and over to you, sir.
Thanks, Ikra. Good morning, everyone, and a very warm welcome to the Q3 FY26 earnings call of Epack Durable Limited. We have the management today being represented by Mr. Bajrang Bothra, Chairman and Whole-Time Director, Mr. Ajay Singhania, Managing Director and CEO, Mr. Narayan Lodha, Executive Director and Group CFO, and Mr. Rajesh Kumar Mittal, CFO. At this point, I'll hand over the floor to Mr. Bothra for his initial remarks, post which we'll open up the floor for Q&A. Thank you and over to you, sir.
Good morning, everyone. I am Bajrang Bothra, Chairman of Epack Durable, and I warmly welcome you all to our Q3 FY26 earnings conference call. The Board of Directors have approved Q3 FY26 results on 20th January 26, and I trust you all had the opportunity to review them. As many of you know, Epack Durable is India's second largest ODM in the room air conditioner segment. While RAC continues to remain a strong and scalable core business for us, we are consistently diversifying into higher growth and structurally better margin categories. Our revenue mix is becoming more balanced and dependence on the top customers are steadily reducing. This reflects both the broadening of our customer base across product categories and the increasing contribution from new verticals. Over time, this will make our business model more resilient, improve margin stability, and reduce concentration risk, while positioning Epack for more sustainable and profitable long-term growth. Joining me on today's call are Mr. Ajay Singhania, Managing Director and CEO, Mr. Narayan Lodha, Executive Director and Group CFO, Epack Group, Mr. Rajesh Kumar Mittal, Chief Financial Officer, Epack Durable. They will take you through the details of our operational and financial performance for the quarter. Thank you. With that, now I hand over to Rajesh Mittalji, our CFO, Epack Durable, to take you through the key financial highlights for Q3 FY26. Thank you.
Thank you, sir. Good morning, everyone. Welcome to our earnings call for the third quarter of the financial year 2026. I would like to thank our host, DAM Capital, for arranging today's earnings call. The key highlights for the quarter and the period under review are as follows. For the third quarter under review, revenue from operations stood at rupees 427.8 crore, which increased by 13.5% on a year-on-year basis. The EBITDA for the quarter was rupees 31.7 crores, increased by around 31.5% on a year-on-year basis. The EBITDA margin reported at 7.41% as against 6.39% on a year-on-year basis. The net profit was rupees 2.6 crores, which increased by 4% on a year-on-year basis. However, net profit margin contracted by 5 basis points to 0.61% due to higher depreciation and finance cost. Now, I would request our Managing Director and CEO, Mr. Ajay Singhania, to brief you on the operational highlights.
Thank you, Rajesh, and once again, good morning, everyone. The company reported a healthy performance during the third quarter, with performance broadly in line with our internal targets. Despite a challenging external headwind, we delivered a resilient performance. We also continued to strengthen our core business fundamentals during the quarter. We added 2 customers during the quarter for whom supplies have already commenced. With this, our total customer base has increased to 67 over first 9 months of the year, in line with our growth objectives. Our washing machine business is also ramping up well and is expected to become a meaningful contributor to both revenue and margin over the coming years. With an improving product mix and better asset utilization supported by strong execution and continued focus on operational discipline, we remain firmly on track to deliver EBITDA margin expansion and stronger profitability on a year-on-year basis. From a segmental perspective, our AC business segment witnessed a marginal 1% year-on-year decline during the quarter. However, there is a strong performance across our other business segments, hence our overall revenue has grown, reflecting the success of our diversification strategy. The small domestic appliances segment grew by 30% year-on-year basis, driven by healthy order inflows across both existing and newly launched product categories. Demand for air fryers have been very encouraging and is gaining good traction with customers. Our component segment delivered a standout performance, recording a strong 61% year-on-year growth, supported by robust order pipeline for PCBs, copper parts, and plastic molded components. The large domestic appliances segment reported an impressive 74% year-on-year growth, driven by our continued focus on expanding product and diversifying customer base. Notably, our product business contributed 75% of total operating revenue during the quarter, reaffirming strong customer confidence in our core offerings and highlighting healthy market adoption across categories. In line with our strategic scale and diversify, we have also taken a significant step in expanding our component segment. This is a deliberate and strategic move to reduce concentration risk while positioning the company in adjacent high-growth industries. We see this as an important long-term growth lever that strengthens our business portfolio, enhances resilience, and opens up new cross-sector opportunities for sustainable value creation. We remain committed to long-term value creation through strategic capital investments aimed at expanding capacity and supporting our diversified growth roadmap. By the end of Q3 FY26, we made steady progress across multiple key locations. We have incurred in 44 crore of capex in Q3 FY26, primarily directed towards capacity expansion and equipment installation for washing machine lines component segment at our new City plant. Additionally, investments made at our JV facility with Hisense and our new greenfield plant in Bhiwadi are expected to commence production in coming quarters. These investments, along with the upcoming growing customer engagement, continued expansion of our product portfolio, position us well for the future growth. With strong foundation in place, focused execution, we remain confident in achieving our full year targets and sustainable healthy revenue and growth margin going forward. With this, we now open the floor for Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sukrit D. Patil from Eyesight Fintrade Private Limited. Please go ahead.
Good morning to the team. I have two questions. My first question is to Mr. Ajay Singhania. As RAC now contributes less than 60% of the revenue, what specific initiatives are being taken to accelerate scale in SDA and LDA? Over the next 12 to 18 months, how do you see Epack positioning itself to capture demand across Tier 2 and Tier 3 markets? And what role will backward integration or design play in strengthening the competitiveness? Thank you. That's my first question. I'll ask my second question after that.
So regarding our specific initiatives, especially to grow the small domestic appliances, large domestic appliances, as shared earlier, we are diversifying both by increasing the product offerings as well as diversifying into acquiring of new customers. So especially in small domestic appliances, we've increased our product portfolio by introducing two new products in the current quarter, the last quarter, air fryers and nutri blenders. Going forward, we have plans to further expand our product portfolio and introduce newer products like coffee makers, tower fans, air purifiers, etc. So with this expansion of product categories and acquisition of more customers, we are poised on strong growth. Similarly, for large domestic appliances, our washing machine category, we already started the fully automatic top-load washing machines. Going forward, the company is also launching the front-load washing machines as well as the semi-auto machines. So with this, we believe that we will have a complete basket of product offerings to the customers, and definitely the growth in both the SD and LD categories is very high.
Thank you. My second question is to Mr. Lodha. With EBIT margins improving over 100 BPS year on year, how are you planning to balance cost efficiency with capital requirements for scaling SDA and LDA? Could you share how the company is approaching working capital optimization and funding to support multi-category growth while still protecting the profits? Thank you.
So while evaluating any product, whether it is SDA, LDA or any line, we deploy the capital allocation very diligently. We monitor the cost on our product wise and return on each and every product. Before launching any product, our internal team and every R&D team develop the product. And once the product is validated and approved by the customer and desired IRR and return is being calculated, that's why we make the investments. So despite the increase of our portfolio and other things, our EBITDA margin is increasing. And going forward, when the scale will be there, definitely it will broaden our overall margins.
Thank you for the guidance, and I wish the entire team best of luck for the next quarter.
Thank you.
Thank you.
Thank you. The next question is from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity, and congrats to the team for a good set of numbers given the volatility in the entire segment. Sir, two questions. One, how do you see the overall AC industry panning out? One, what was the growth in December quarter? Secondly, now from January, we have shifted to new BE tables. So what has been the price hike? Again, copper and aluminum prices have gone up. So how it will have impact on the pricing of the products? E-waste cost has also gone up. So considering all these things, how do you see the impact on the pricing of the products? That is question number 2. And 3, in terms of overall, how do you see the entire sector panning out, at least in Q4? Because at least so far we have seen, or whatever channel checks we have done, is we understand the growth has been bit slower in December and again even in initial 15 days of January also. Yeah.
So thanks, Anirudh. I think you are already aware that the first 2 quarters where the industry degrowth was anywhere between 25 to 30% kind of degrowth is what the industry has been experiencing on primary sales, whereas as far as secondary sales is concerned, the degrowth has been close to 15% for the first 2 quarters. Post the GST reduction, there was some slight recovery, and so Q3 was a cheer for the industry that the degrowth has reduced, and presently it seems that on the secondary side the degrowth is anywhere around 10 to 12%. On top of it, especially for manufacturing, there was a big push, especially in Q3, to ramp up production considering the upgraded BE norms coming into effect from January. So the demand for RAC is gradually improving. With implementation of new BE norms, the industry has begun especially from mid of January, the production ramp up has again started for the newly rated BE production. Q3, there has been liquidation of primary inventory by most of the brands as far as we know, since these products could continue to be sold in the trade till end of June. So the channel inventory, yes, is definitely a little high, but it is expected to normalize post Q4 FY26, supporting healthier demand and production planning going forward. And especially with the new products, there is definitely a cost escalation on account of the newly designed product as well as commodity impact of Q3 getting passed on to Q4 would be minimum. So both the as well as the commodity impact currently seems around 8 to 10%, especially for the production, ongoing production in Q4 currently. And any further increase in commodities definitely will have further impact on the pricing going forward. Having said that, for Epack, the margins are still protected because for us all commodities are passed through. So that protects us, but that definitely remains the concern considering the market demand outlook if the commodities continue to grow at such significant high levels.
Sure, sir. Understood. Helpful. But do you see the primary sales would have happened? Means the brands like Voltas Blue Star would have sold to the trade, and hence the inventory at the brand level would have gone down. So there will be more need for manufacturing, and they will be sourcing more products from us in Q4. Will that be a fair understanding?
Absolutely, yes. So yes, both Q3 and now Q4, the demand outlook is very robust, and all the brands are planning growth over financial year 24-25 because FY25-26 has anyways been a bad year. So most of the brands are planning anywhere between 15 to 20% kind of growth over FY24-25 numbers, and based on it, the current order book is very robust for us. And we firmly believe that this momentum will continue, and the demand outlook as of now is very positive.
Okay, sure, sir. Very helpful. Many thanks.
Thank you. The next question is from the line of Praveen Sahai from PL Capital. Please go ahead.
Yeah, thank you for the opportunity. Sir, just a clarification. To what you had given some numbers like 25 to 30% of a decline in the first half of the primary sales, which has reduced to 10 to 12%, what you said, by 9 months?
So, Praveen, at 25 to 30% degrowth was in primary sales, whereas the secondary sales was still at 10 to 12% over last 9 months. Which means that the inventory build-up which has happened in previous year was kind of sold off.
Okay. And secondly, on the, you had also guided for the way forward 20 to 25% of a growth for you. So you are expecting whatever the liquidation by the brands, especially in terms of the primary sales, which has happened in the Q3, that giving you indication that's the way forward, the growth for you.
So currently, in line with our discussion with most of the large brand customers, most of the brands have planned 15 to 20% kind of growth over FY24-25 numbers, and the current RFQs and order book is in line with such escalated demand.
Okay. And on the pricing, 8 to 10% of a price hike to pass on the inflation. So that is for you are talking on, or at the the brand level or the sector level you are talking about 8 to 10% of the price?
This is across industry. Praveen, this is across industry for both us as well as the brand. The kind of increase which has already impacted the ongoing production with the new BE rated products. So part of it is on account of the new star rating, and part of it is the commodity impact which has already impacted the industry in last quarter.
Okay, fine, sir. And now moving to the another, the part of your business, which is a component. And in the component, you had mentioned that there is a good order pipeline of a PCB, copper parts, and the plastic molding. So which product order pipeline is on the higher side? Is it more towards a plastic molding or some other product?
So for us, component business as a whole, all the three categories, the copper parts, plastic and PCB are rapidly growing. For plastic especially, we are doing a lot of components like cross-flow fans, wherein we have approvals from almost all the marquee clients. So plastic parts, PCBs, copper, all three, the entire component segment is what we see growing at a much faster rate.
Okay. And
these are
if
not
you
just
can...
components for AC, these are also for other diversified appliances.
Okay. Also, if you'll give us some indication on all the four segments like RAC, SDA, and LDA and the component, how is the margin profile?
Since we are not reporting margins at segmental basis, I can briefly talk at a very high level. I can talk in terms of overall gross margins category wise. So even in my earlier calls, I've said that for AC being a high ticket size product, the gross margins are the lowest, whereas for the small domestic appliances, the low ticket size products, the gross margins are relatively better. So considering our overall gross margins net of BOM cost at around 14 to 15% level, which is largely indicative of the gross margins in air conditioning. For small domestic appliances and large domestic appliances, the gross margins are comparatively better at around 16 to 17%, and similar is the case with the components. So hence, like we see for the results declared in Q3, the margin improvement has been on account of the increased revenues from the other sectors, the other segments.
Right. And any indication like how your X of the RAC segment contribution for next year?
So going forward, we continue that our growth in SDA, LDA and components will be much bigger, and whereas the AC will also continue to grow. So our overall guidance remains that AC will be at around 60 to 65% of our total revenue, small domestic appliances at around 12 to 15%, and components again at around 20%. So that is the kind of overall guidance we have for the product mix and the revenue mix.
Right, sir. And just a clarification, sir, lastly, that 20-25% value terms you had, indicating the growth. Yeah.
Yes.
Thank you, sir, and all the best.
Thank you so much.
Thank you. The next question is from the line of Raman KV from Sequent Investments. Please go ahead.
Hello, sir. Can you hear me?
Yeah.
So, I just have one clarity. You have said 20 to 30% revenue growth in the coming year, FY27. So this is on the FY27 24 days or FY25 days or 26 days, the growth.
So for FY27, we have not specially shared any revenue guidance as such. We are talking about the industry growth and the growth in air conditions. So we are discussing that the growth of AC market is currently seems to be at around 15 to 20% kind of growth in AC numbers for the industry for the current calendar year 2026 is the ongoing discussion. Yes.
So you are expecting after 3 quarters of the growth, you are expecting a 20-30% growth in future with respect to AC. If my understanding is right.
So we are talking again. I repeat. So this is in this line with the calendar year discussion for the seasonal AC market. So for the current coming season of AC, the market is planning a growth of around 15 to 20% over the FY24-25 number, because the calendar 26 was a degrowth. So calendar 26 seems that the market will grow at around 15 to 20% over calendar year 24. And this is the industry growth we are discussing. Yeah.
Understood. And so I just want to understand your CapEx plan. can you give us a ballpark update on the capex, current ongoing capex and future capex with respect to washing machine and component manufacturing expansion?
So, in our opening for this financial year, we have given a guidance that the company is looking at an investment of around 450 crores over next 12 to 18 months. In line with that, the company has already incurred a capex of almost 220 crores in last 9 months. So in quarter one, we had an investment of around 45 crores. Quarter two, 130 crores, and quarter three, the last quarter, another 45 crores. So totally 218 crores is something the company has already capitalized in last 9 months. And in another 6 to 9 months, we are looking at an additional 225 crores.
Understood, sir. And so my final question, if possible, can you give us a guidance for the coming year?
So, the growth in AC is expected to be around 15 to 20% for the coming 4 to 5 years, and the company is poised strongly to grow at a much faster rate, at least at 25 to 30% growth in AC in next 4 till 2030 is the kind of outlook we have. Whereas our other segments like LDA would grow at a much faster rate. So while we continue to grow for AC, our growth in SDA, LDA and components will be much higher.
Understood, sir. Thank you so much.
Thank you, Raman.
Thank you. The next question is from the line of Anupam from SUD Life. Please go ahead.
Hi, sir. Good morning. Sir, if you can highlight, sir, what is the bold rated...
Excuse me, Anupam, can you be louder?
Yes, sir. Am I audible now?
Yeah.
Yeah. Sir, if you can give us some light on the old rated stock in the industry and what sort of our brand saying on the new rated how the order pick up and ramp up is happening. As such, what is the strategy from the brand in the new rated units?
So Anupam, as far as the old rated product is concerned, the last date of production for the same was 31st of December. Our estimate is currently, and the trade inventory put together, the overall inventory level in the market is approximately at 4 to 4.5 million is the kind of inventory currently in the trade, which includes the inventory with the trade partners, brands, everywhere put together. As manufacturer, we are not allowed to carry any inventory of the old rated product. So we have zero inventory of the old rated product. This inventory for the rated over Q4. However, it is allowed to be sold till June of 26. The new rated production, the production for the new rated product for everybody. This is gradually ramping up. Going forward, the entire production has to be done with the new rated product only.
Okay. So just one more, you may have repeated this. On the summer outlook, how are we ready? Do we see, let's say, first half, any growth than the last year? Because last year there was a good sort of production happened. How production or sales do you expect in this first half of next FY27?
So, for the current calendar year, Jan to June, if I talk about, like I've been repeating, the industry is preparing itself for a growth of almost 15 to 20% on calendar year 26 numbers. Hence, we are very positive that both Q4, Jan to March, as well as April to June are going to be significantly better as compared to the last financial year. And the industry is looking at a growth of 15 to 20%. However, having said that, for the entire financial year 25-26, we believe that the industry, the growth would be close to 10% overall.
Got it. Understood, sir. Thank you. I'll join back in the queue.
Thank you. The next question is from the line of Disha from Sapphire Capital. Please go ahead.
Hello.
Yeah, hello. Yeah.
Hello.
Yeah, Disha.
Yeah. So I think you mentioned that around AC, I think you're targeting 60-65%, and SDLD around 15-20%, and components the rest 20%, right? For next year.
Yeah.
The product mix. But like going ahead, because you mentioned that we see LD, SD, and components growing much faster than the AC growth. So what is the sort of target product mix you have, say, 2-3 years down the line?
So Disha, for medium to long-term horizon, this is the outlook that we are trying to diversify and reduce our overall dependence on AC. And as we can see over the last 3 years, we have gradually reduced dependence on AC from 80% to now currently 57 or 60%, and it will further reduce to around 55% in a medium term, let's say till FY28-29 kind of. So that's the overall guidance, that AC contributing 55% of the overall revenue, and our SDA, LDA growing to 25%, and component another 20-25%. So that's the overall revenue mix the company is looking in the medium term horizon.
Okay, in the medium term. All right. And so for FY27, what sort of EBITDA margins are we targeting?
Again, we don't give guidance on financial to financial basis, but overall the company is confident that we will maintain EBITDA margin of 7.5 to 8% in medium to longer term horizon.
Okay, all right. That's it from my side. Thank you.
Thank you. The next question is from the line of Tanisha from DAM Capital Advisors. Please go ahead.
Hi, sir. So just one question, just a couple of questions.
Can you be louder?
Yeah, am I better now?
Yeah.
Yeah. So just a couple of questions, right? Starting with AC. We've spoken about how channel inventories are yet at around 4.5 million. And, commodity inflation to that extent also calls for price hikes, which are pretty steep. So going ahead, while the brands are also expecting a 15-20% sort of a growth for the calendar year, what are the potential risks to this growth, which you are seeing obviously, with this whole commodity inflation sort of playing out? So there is one bit where brands are sort of positive on demand, but at the same time you have these costs, coming up as well. So what would you sort of, comment on that?
So today you are an industry expert. You know that the risk with any industry, and especially seasonal industry like AC, especially the demand in terms of the seasonal lift is always there. But however, especially when we are talking about the India market and the overall potential, the tailwinds are still strong with the lowest penetration. One of bad season does not indicate that the overall industry is not poised to grow. So like I've been repeatedly sharing, a 15 to 20% kind of growth in medium to long term horizon is what the industry is definitely poised to achieve. And by almost 2030, the industry is looking at a demand of anywhere up to 28 to 30 million is the kind of numbers what everybody is projecting. So the overall tailwinds still remain very strong, and especially with now the BE ratings improving year on year, the efficiency is going high, the electrification, the incomes, per capita income improving. We have witnessed that in last 3 to 4 years, the overall seasonality effect has reduced, and AC is becoming more of a uniform demand across quarters, although not to that level, but then it is significantly improving every quarter. Hence, any seasonal risks are getting reduced year on year. And especially if we are worried about one bad off season in calendar year 25, it has to be also looked from the perspective that the year previous to it grew at almost 30% plus. So already at a much higher level, this kind of risks are always there. But now the overall demand situation seems to be more rational and uniform. Hence, the risks are bare minimum.
Got that. So, and second, in your opening remarks, you also spoke about how washing machines can be a meaningful contributor to revenues and margins. So, any comments on how we're sort of scaling that up? You spoke about getting into top loads and then front loads also. Given that, in the industry there is barely any outsourcing which happens for front loads, almost minimal, what is our plan out there in terms of washing machines?
So, Tanay, in terms of washing machine, we had started our top load fully automatic washing machine almost 2 quarters ago, and now we see significant ramp up happening with acquisition of 2 key new multinational customers with whom the demand outlook is extremely good, and this gives us a lot of confidence. We are already witnessing a large ramp up happening in our washing machine category, and with our Hisense JV, we have already started now the setup of our new line for the front load, again wherein we see Hisense as one of the key customers, and then other customers are also in the pipeline. So like you rightly said, currently there is no meaningful outsourcing happening for the front load, but at the same time there are no established manufacturers also in India for the front load. So that gives us confidence, and this is what we see as a growth contributor, which will then drive our further growth in washing machine category. Semi-automatic or twin tub is a category just to fulfill the entire product catalog, the product offering. So for us, the focus remains largely on the fully automatic, both top load and front load, and we see significant ramp up happening in next 3 to 4 quarters.
Got that, sir. Okay. Thank you, sir. Thank you.
Thank you, Tanay.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good morning. So my first question is, this 15-20% growth you're talking about is volume terms, I assume. Or
yes, Ashish.
That's for then. Okay. And then secondly, the 4.5 million inventory that you spoke about at the end of September with the channel and all, what would it be in a normal year? Will it be like half of that number?
Again, these are estimated numbers, but typically the opening inventory in the Jan quarter for the industry is to take care of the projected sales in the current quarter. So that's how the overall inventory levels are typically. So again, it would be a very rough estimate, but not half. If today we are seeing 4.5 million, probably the earlier years it would have been at around 3 or 3.5 million. So the inventory levels are now not significantly high. So they are well within the band of, let's say, excess of 20% or so.
Got it. And sir, just lastly, in terms of the cost or price inflation, when you spoke about 8 to 10% price hike is required, that is factoring the current commodity prices, or what does that factor in terms of commodity?
In terms of commodity, there is a lag of 1 quarter. So it factors the commodity of previous quarter, which is October, November, December.
The average of that quarter. I'm asking because it has been a one-way direction in terms of commodity. So when you say previous quarter, is it average of that? How does it work?
Average of October, November, December.
Average of that.
And yeah. So
the current number is already higher, right?
Yeah, so very broadly, if I say 8 to 10% hike in price, 50% of it is contributed by the re-rating of the products, the BE, and almost 50% because of the commodity increase in the last quarter, October, November, December. So that is something which will impact the new rated product, which is currently ongoing in Jan, Feb, March quarter.
Got it, sir. That's very helpful. Thank you so much.
Thank you. The next question is from the line of Bhanu from Three Head Capital. Please go ahead.
Hello. Good morning. Hope I am audible.
Yes, sir.
Can you hear me?
Yes,
okay. Yeah. Sir, I am very new in this industry and in this company. Sir, can you tell me our payable stay reduce drastically? This is for a seasonal phenomenon?
Can you bit clear and slow? We are not able to.
Okay. Our payable days reduced drastically. This is a seasonal phenomenon?
Payable days. Payable days will get. Oh, okay. So the trade payable days for us has reduced because we have been carrying inventory, paid inventory, and there has been no new procurement done largely in the last quarter. Whatever inventory was left over because of the demand being going down due to unseasonal rains has now been consumed in the last quarter. So there was no need for
Okay. But what is the normalized payable days and going forward we can expect?
So normalized payable days are between 90 to 100 days.
Okay. My second question is, which of the revenue we are calculating in the other income, the other segment?
Sorry
in our revenue?
No. Can you please rejoin the queue for more questions?
Other revenue includes basically whatever the component which are supplied as a spare part. This is known as other revenue.
Okay.
And apart from that, there is a other income which is there in other income, not in other revenue. Those here. So there is around 100 crores there, which is basically spare parts of AC.
Okay. Thank you, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Arshia Khosla from Nirmal Bang Institutional Equities. Please go ahead.
Yeah. Hi. Thanks for taking my question. So I just want to understand on the components part of the business. It has been growing good for the previous couple of quarters. So AC basically being very muted, the AC industry, what is leading to this components growth? I mean, what are the different specific industries that you are also supplying to apart from REC?
Asia component sales for us is to not only AC industry, it is to electrical meters, it is for coolers, it is for washing machine. So there are multiple products, categories or appliances wherein we are supplying the components.
Okay, understood, sir. And on the LDA as well, I mean, we've seen a good growth in this quarter. So what are the specific products, if you could just highlight for driving this LDA demand?
LDA currently we have only two product categories, cooler, which is now almost a year-old product for us, and then second is the newly introduced washing machines. Coolers and washing machines are the two product categories, and both are very new, and we see significant ramp-up happening in the coming quarters in both the categories.
Got it. But I'm assuming coolers have still been muted this quarter, right? And so the basic demand is coming from washing machines only.
Yes.
Got it. And so lastly, how are we placed on Hisense? I mean, are we completely on track for Hisense specifically for REC? Are we doing the new BV-rated products?
So Hisense, like we've been sharing earlier, one is the ODM product, which is currently being supplied from our existing City plant. So that ramp up is happening and the supplies have been consistently going on in the last year. The newly formed JV facility, which was under construction, has now completed the construction and trial production is on track and have progressed very well. With all key milestones achieved, the facility is now ready to commence production in the current quarter, which is Q4 FY26. The plant will initially manufacture RACs for domestic market and will gradually expand to export market, particularly focus on Middle East, GCC countries and Africa. And this facility will not only be confined to RACs for Hisense. Going forward, the plan is also to manufacture the fully automatic front load washing machines and then TVs also, which we will start ramping up and introducing every quarter. So there is a large pipeline and a complete roadmap in place to streamline the overall production, products and customers at the Hisense JV.
Sure, sir. Thank you. That's helpful.
Thank you. The next question is from the line of Mr. Achal Lohade from Nuvama Institutional Equities. Please go ahead.
Yeah, good morning, sir. Thank you for the opportunity. Just wanted to understand in terms of the cost impact, while you have talked about in percentage, but I just wanted to understand, on an absolute basis for a 3-star inverter, which is the most popular SKU, what is the actual BOM increase in price of what you have seen basis October, November, December prices? Is that closer to 2,000 rupees? Is that 2,500 or more of 1,500?
So actually, it's an interesting question. It will be difficult to answer in absolute terms because it will vary from brand to brand and model to
Average.
model. Even
Yeah. Fair point.
But on an average, like I shared earlier, especially for 3-star, the cost increase because of the BE upgradation is anywhere between 3 to 5%, whereas for 5-star it is, let's say, slightly more at 5 to 8%. And similar is the commodity impact for 3-star. The commodity impact of the last quarter compared to the last year December quarter is 5 to 6%, whereas for the 5-star it is slightly more. So when we say that the overall cost increase is 8 to 10%, it is considering an average of 3-star and 5-star. The increase on 3-star is slightly less, whereas on 5-star it is more. And hence we have seen that even in last quarter, majority of production which was being done by the brands have been focusing towards increasing the 5-star production.
Understood. And given the prices have risen, commodity prices have risen further in Jan, does that mean that there has to be further price increase in April, May, June for you?
The current quarter impact is something which still needs to be assessed, and I think we will be in a better position once it stabilizes. So because it has to be an average of at least Jan, Feb, March, we will have to slightly wait and watch how whether it stabilizes or it continues its upward trend. But under the current circumstances, the second price increase is something which is imminent.
And is it fair to say that the pricing methodology is fairly standard across the industry, across the players, across the brands?
Yes, it is more or less industry standard.
So the margins are on a per unit basis. Have I understood right, sir?
Yes, actually, yes.
So theoretically, a percentage margin could look lower in FY27 if the current prices were to sustain.
So it is difficult to put numbers in that way. But yes, if the commodity impacts are passed as it is or as a passed through per unit basis, yes, the margins might look slightly subdued. But the overall EBITDA and the growth will still continue.
That's fair point, sir. Thank you, and I wish you all the best. Thank you so much.
Thank you so much.
Thank you. The next question is from the line of Bala Subramaniam from Arihan Capital. Please go ahead.
Good morning, sir. Thank you so much for the opportunities. Sir, we are strategically expanding components, specifically energy meters, audio, through Epack components or engine audio. And how does the margin and ROC of these new component businesses compared to legacy ROC component business?
Mr. Bala, I think I answered these questions previously also. I repeat the same. Since we are not reporting at segmental basis EBITDA margins, for us, I can largely give an indication in terms of the overall gross margin. So the material margin in component is comparatively better as compared to the overall RAC, which is typically at 14 to 15% material margin. The component gross margins are somewhere at 16 to 18% kind. So that's again a very broad guidance because we are not reporting numbers at segmental basis, but that's broadly the guidance I can tell you.
Okay, sir. Sir, I think 3 years back, our top 2 customers nearly accounted for nearly 70% of revenue. I think it's been reduced to 38% in Q3, 9 months of FY26, and maybe next 2 to 3 years time frame. So, what kind of further diversifications we can expect? I think we are adding a lot of new customers. I think recently we also had a partnership with Panasonic and Daikin. And I just want to understand how these diversifications will happen over next 2 to 3 years time frame. And also you can mention what are the upcoming products like a tower fan, hair dryer, air purifiers. So what are the expected launch timeline and addressable market for these products?
Mr. Balasubramaniam, I think we have now reached a very ideal situation wherein the top 2 customers contribute to 35 to 40% kind of revenue. where while we continue to grow our other product categories, we are very mindful that we also need to look at increasing our wallet share from the existing customers. So not be a one way wherein we continuously keep on reducing, because we also want to increase our wallet share with each of the existing marquee clients. So at the current level, we think we've optimized it largely in last 3 years, reducing from almost 70% plus to today 35 to 40%. And this seems to be quite an ideal number. Any further reduction is not what we are looking at. We are looking at increasing our wallet shares by offering diverse products to the same customers, because cross-selling is something which definitely helps us to achieve better revenue growth and better margins. But anyways, in the medium to long term, we see that our overall dependence on top 2 to 3 customers should be maintained anywhere around 30%.
Okay, so my second question, I already mentioned that upcoming products like a tower fan, hair dryer, air purifier. So what are the expected launch timeline and addressable market of these products?
So each of these markets are part of our overall SDA growth roadmap, wherein every quarter we are looking to launch new product categories, 1 to 2 newer products, and then look at gradually ramping up. So in the current quarter 4, we are looking to launch at least 2 new products, vacuum cleaners and tower fans, and then slowly use them as so this would be the launch pad, and then gradually start ramping up this product category. We also understand the limitations that we cannot continuously keep on increasing the overall product categories year on year. So especially in small domestic appliances, we want to limit ourselves at overall product offerings of 8 to 10 numbers, and then create each category as a growth lever, and then do both horizontal and vertical deployment by way of backward integration, and then penetrating newer customers, increasing the product portfolio. So the next journey would be on increasing the margins in the newly launched product categories by way of backward integration, increasing our market share. So yes, we are increasing the product categories, but at the same time we are also very mindful that it consumes a lot of bandwidth, so we cannot keep on increasing continuously.
Got it, sir. Thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 1 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Vidisha from CR Kothari and Sons. Please go ahead.
Hello, sir. Hello, am I audible?
Yes, please go ahead.
Yeah, so given the revenue declined around 13-14%, so what is the outlook for quarter 4? Like, how will FY26 pan out? Any revenue and margin guidance?
Vidisha, I think like I have shared earlier, since REC contributes almost 65 to 70% of our overall sales, and wherein we have witnessed the industry to degrow at 10 to 15% is what the industry degrowth we estimate at the end of this financial year. So in line with that, our key sector AC, definitely we will see an overall degrowth, but for the overall revenue numbers, our other levers like SDA, LDA components have helped us recover a lot of that lost revenue. And at best, currently we are estimating a flattish kind of revenue for the current financial year FY25-26. Or a marginal growth. So at best, a flattish or a marginal growth in overall revenue numbers what we are looking. Or in another way, we are saying that the degrowth in AC, we are looking to recover from our growth in the other diversified sectors.
Thank you. The next question is from the line of Aryan Bhatia from Inved Research. Please go ahead.
Thanks for the opportunity, sir. My question is on Epack. So if I look at the past few quarters, it has been constantly making losses. And we are beginning the commercial production in Q2 FY26. And if I look at the history of the company as well, it has been making losses. So what gives us the confidence that we will be able to make the loss-making company profitable in the upcoming few quarters?
So Aryan, Epack for us is a strategic investment. So it is not only a backward integration, it also helps us support the growing demand for energy efficient since the BE rating is upgraded every year, the application is increasing every year. And we are not only looking to manufacture motors for AC, but also for other appliances like washing machines, fans, HVLS fans. So the new greenfield facility in Bhiwadi commenced trial production in end of Q2. Q3 we have seen the ramp up happening, and as in Q3 the AC market has recovered. There has been some sales which has happened, but more importantly for us, the approvals from all the key clients has happened, and Q4 onwards we are looking at reducing first the loss year on year, and definitely FY27 we will see this company turning into green from red.
Thank you. The next question is from the line of